famous. Then we have another market we call the money market, where we do the lending among the financial institutions,
Right.
or with the central bank. So that is very regulated. Right? So I don't think SPPI would have a bigger problem where we are. It becomes a problem where the banker or the lender is structuring
Correct.
the product in to fit to give us some advantage over the competitor, or to tap a particular consumer market.
For example, I'll give you an example there. That what happened in the crisis two crises ago, old people said, "I'm never buying shares." This is after the crisis, the .com, which is 2002. So because old people said, "I'm not going to buy shares," the bank said, "I'll tell you what, Grandma, here's a product for you. We're going to give you a really crappy interest rate, but we're going to give you half of the increase in the stock market index." So it was a mainstream product in banks in the UK. So the interest basically consisted of a sub-market interest rate plus a top-up based on the price of the share movement. So if the share prices collapsed, you had a floor. If the share prices boomed, you had a bonus payment. This was mainstream in the UK, focusing on older people, because older people after 2002 said, "I'm never buying shares again," remember? And they said the same thing again in 2008. And they started buying shares later, right? So this is an example of a structured product. What structured products do you have here in Pakistan? For consumers?
We do have some perpetual convertible bonds.
Convertible into? Do the banks offer this? So convertible into shares of the bank? Okay. But from the banks...
The word perpetual.
Yeah, they are perpetual. They're on the basis of loss absorbency clause, they are the Basel.
Yeah.
But then that's not for the public, it's for qualified investors.
Yeah.
Understanding of the market.
So those qualified investors would treat those at fair value to net income. But do you have any things where you're the holder, not the borrower?
We did investment in those kind of bonds.
Oh, so that's in other banks, yeah.
See, the problem here is we have got another alternate system. We call it Islamic banking system.
Yeah.
There the
It's
products
big in the Middle East as well.
The products are no, in the Middle East, everything is Islamic, mostly.
Well,
Majority. Here we have got a smaller portion of the economy or the banking
this is not...
being done by that alternative method, and there you actually structure the product, and there SPPI loans, for example, there is a loan with no interest element, or there is a loan which is the interest is determined against another yardstick.
Yeah, I get it.
Right? The Musharaka and other agreements that we call them. So there you have a difficult SPPI case, but for the corporate loans, which are you're lending and over a reference rate, you are receiving the interest, SPPI case is simple.
Yeah, so I think in the Middle East, Islamic finance is a bit of a can of worms. I think they still treat those as amortized cost. IFRS isn't really designed for Islamic finance. Or IFRS doesn't have exemptions for Islamic finance.
Arrangement or the contractual definition of the product is there. You can apply the SPPI test there.
Correct. And oftentimes...
It's difficult to pass this test.
Yeah.
Business model test is easier. That makes sense. But when you go for SPPI, there are other elements which you need to satisfy. For example, the asset backing that particular transaction, that also has a fluctuating value. So this is where it gets complex.
Yeah, I'm not a whiz on the Islamic finance, but what I've seen in the Middle East is a lot of those are still at amortized cost.
Even here as well, we try to pass the SPPI as a proxy. For example, we did it for diminishing Musharaka where the asset base is there. So what we did is we said that it's a unit-based purchase sales is there. So we have the principal and the interest portion is there. So we pass the SPPI test.
So I guess the concept is, though, we need to determine, is it similar to the market interest rate? Sometimes you speak to people they get upset with the term interest. But from a European perspective, to us, if I give you money today and you pay it back tomorrow and there's a difference, it's interest. That's how we look at it. Some people get upset with that concept, but that's how we look at it. So if you apply the same concepts and you do the calculations, it would be the same. It always becomes into this scholarly debate there sometimes, because they say, no, there's no interest.
Because here, theoretically, even that loan transaction is under the contract is a trading transaction. You're actually buying and selling an asset.
But in substance, you're not really. I guess the difference is Islamic finance is form-based, IFRS is principle-based. Yeah. So in Islamic finance, substance over form, the legal substance is you sell corn. But the substance from an IFRS perspective is you don't actually see, you don't even know what the commodity is sometimes, right? Or what's the commodity? Okay. So you don't, the substance we would say in an IFRS angle is it's a loan.
The lacuna is that contract is approved by the Sharia advisor.
Yeah, I know. So if you want to change the term to markup or whatever, so what? IFRS doesn't preclude you from calling interest markup. But you have to do the same calculations in IFRS 9. In substance, that's what it is. So,
I just needed to ask you about the question you just did.
Go for it. I forgot what you were going to ask.
The cash flows didn't include interest, right? There was only
What's cash flows?
the cash flows that the doctor was receiving from the patient. It was just the
Correct.
So won't we say that since the cash flows, so basically the flow chart.
But hold on. Whenever you sell something and it's more than 1 year, the interest is imputed. So that.
But the cash flows don't include interest.
But no, that they do. It's imputed. Yes, they do.
Implicit.
It's implicit. Cash flows always include interest. It's implicit. It might be stated or it might not be stated. It doesn't matter. If I say the interest rate is 0, it doesn't mean the interest is 0.
The important thing is it should not be anything other than principal and interest.
Correct. So it's an imputed time value of money. The problem with this question here, because the doctor sometimes collects the contractual payments, which is principal or interest, and sometimes they sell it, that's a mixed model. And because it's a mixed model, they have to use fair value to OCI. By the way, you're allowed to sell securities if it's part of your collection process. So you give loans to people, and what you do is you sell the loans at the end of the process that are hard to collect. Say if they go into stage 3. And your credit policy is, when it goes into stage 3, we sell it. That's okay. Because that's how you deal with your collection of troubled debt. That doesn't negate the fact that it's going to be the business model to collect the contractual cash flows. So it's allowed to sell the tail, or as they go into stage 3, there's someone else who specializes in difficult debt. That doesn't mean it's not. It's not SPPI okay. But if you sell the good stuff, it's not the tail, the little bits that are going to drag out, but you sell the meat, that's a problem. So, the business model determined by IS 24, very difficult to manipulate. Generally, the number of sales. The more sales we have, the more likely it's fair value to P&L. And the less sales we have, it's more likely to be amortized cost. Because you can have some sales for amortized cost. In some markets, the regulator might say, sell these to prove that they're marketable. So if the regulator says, sell some of these securities to show me there's a market, that's okay. So there are, it's not that you can't have no sales. What is your business model? Or what might happen if a credit rating, like what happened with Greece, when companies in Europe go into junk status, some banks' policy is we don't keep junk. That doesn't mean your business model changed. That's your risk management. That's different. So that doesn't negate the business model. So if you have sales, if they're infrequent, close to maturity, that's okay. If they're due to an increase in credit risk, and it's consistent with your business model, that's okay. You only change the treatment when your business model changes. And most banks, these models are pretty regimented. Banks are not like normal companies. They're very rule-based, right? Generally. You know, they make you take vacations, right? If you don't take a vacation, it's a risk. Internal control risk, right? They have to take vacations. And they get paid for this, right? They call it work. Solely payments of principal and interest are things, the credit spread, admin, other basic lending, and a fair profit margin. Okay? So, things to look at. When you have leverage payments, that's going to negate SPPI. If the prepayment penalty exceeds the interest loss. So, if the prepayment penalty is more than the lost interest that you would get, that is not SPPI. If the fair value prepayment option, if there's a huge fair value of the prepayment option, these are some examples here. Equity convertibility clauses. This is 5. If debt instruments are payable at fair value.
I had a question on equity convertibility.
Go for it.
So, recently I find that in this economy, banks have been issuing some long-term debt, and there is a convertibility clause for those debts to qualify as Tier 1 capital.
Right.
And like we all know, sitting in this market, that it will be a remote occurrence for those bonds to be converted into any shares. It's just there in order to meet that condition to qualify as Tier 1 capital. So will we still be counting if my bank is holding any of such bonds? Will this clause be like asking me to do it otherwise?
Yeah, it'd be fair valued. Yes.
Irrespective of how remote the chances are?
Correct. Correct. The contractual features can only be SPPI. There isn't a materiality opt-out here. And obviously, in the argument back, I would say, the fact that the banking regulator requires it to be Tier 1 is because if things go wrong, that's important. So it's a very important clause for banking liquidity. So it's not insignificant.
But in this case, we will assess the business model of the holder.
It's irrelevant because SPPI is not met. Before you even get to the business model, you have to meet the SPPI test. Business model is irrelevant if the contractual terms are not only principal and interest. So what you're saying here is the bank raises money, and in order to qualify as Tier 1 capital, if things go bad, the bank needs to have the conversion feature to convert it to equity. So that if things go bad, that loan won't make the bank go broke. And I'm sure that that bond has a higher interest rate than other bonds.
But not really different.
How many basis points different?
Hardly like 25, 30 basis points.
But 50 basis points is still a lot.
Not in this market for us.
It's 14%.
Okay, 14. Yeah, but it's not insignificant to be 1 or 2 basis. I still say 50 basis points is not insignificant. It's not insignificant. 50 basis points is 0.5%.
It's a way around to, like, I mean, so say for example they are falling short of capital and that's why they raise Tier 1 capital. It's just the bank wants to avoid issuance of right shares.
Yeah, I know.
And then that's about
But the thing is, when there is a crunch, it's an important instrument to manage risk for the banks. You're optimistic. You're saying my bank is perfect.
No,
But as an outsider,
I have invested in other
right.
banks' TFTs, other banks' bonds. It's not my bond that I have.
Correct.
So I'll be collecting interest and principal on that asset that I'm purchasing. So you are a bank in Pakistan and you issued some bonds. I bought it. So effectively,
You invested,
the
yeah.
remote possibility that you'll be converting. Essentially, I'll be collecting principal.
But you're getting more than interest because if the premium there
Yes.
is an extra amount for something else,
Yes.
which is not time value of money. I am paying you 50 basis points in case I get into trouble. That is not interest in the context of IFRS 9. If I pay you 50 basis points in case I'm in trouble and I can make you convert, that is not interest.
Right.
So there is no materiality aspect here. And obviously, because the central bank is making you do it, it's because they consider it to be important. And what you'll find is when the market has problems, that spread will widen because the market's not very rational, right? So in bad times, it'll go from 50 basis points to 300. And in good times, it might go down to 10 basis points. It'll go like this. So the thing about these contractual features, it's anything in the contract that doesn't relate to standard interest. Prepayment penalty is a common one, and equity convertibility clauses. Clauses that impose losses to the lender. So sometimes to be a capital requirement, under certain triggering events, the lender is going to suffer a loss.
Does the cumulative and non-cumulative nature of interest has any effect on that? Let's say there is no convertibility clause. There is only one clause that if the interest, I'm not able to pay the interest, it's the cumulative in nature, or let's say it's non-cumulative in nature. So what will happen in that case?
I'm not 100% sure, but my instinct would be if the interest is non-cumulative,
There is sort of residual interest coming in, or maybe
it could still be SPPI. Because the interest calculation,
1 year you don't get it, next year you get it.
have you had this question before? Well, the concept of interest risk is it's not linked versus equity risk, is interest is linked simply to time value of money. So if you're telling me the interest is waived, if you cannot,
It would be definitely
it's a preferred share you're talking about.
yeah, sorry.
So if the interest, effectively, if a preferred share is non-cumulative, the question is, could that be a debt instrument? Well, first of all, to be debt, well, we don't have that. First of all, in the standard, we don't have that requirement. The issue is, does it meet the SPPI test, right? So if you have a convertible that's non-cumulative, the question we need to ask, the question we have to ask is, are the payments solely interest and principal? Well,